It's a panic move. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's panic at the Fed as they're about to see their latest move could send us into an all-out financial meltdown. And this goes against everything the market is telling you, because as stocks rally today, the market is saying that they buy into the fact that the Fed is going to engineer a soft landing and that the U.S. economy is strong and robust and the labor market isn't going to come unwound. But all this does is beg the question, if the economy was so strong, why did the Fed go for a full 50 basis point cut? Well, it's because they know something that the markets don't, and they're afraid that it's going to send us into an all-out financial meltdown. Now, let's head over to Bloomberg, where we picked today's story up, because I want to start with the market's reaction to the news, and then we're going to take a look at what the Fed had to say during their press conference and why Fed Chair Powell is worried that things are about to get much worse. The S&P 500 hits all-time high on soft landing hopes, and this is the actual truth, because everybody wants to believe in the soft landing narrative, and it has to do with the fact that there's been a lot of risk-taking in the equity markets. People have bought homes, they bought businesses, they've loaded up on debt, and they really want to believe the narrative that this is actually going to happen. And the data says it's absolutely possible, because when we look back at federal funds rate, we can see that there's 20 times in history when the Fed cut rates and stocks went up a year later. And this is why you're going to hear things from the experts saying that the Fed unleashed a massive amount of liquidity. And all this is doing is telling people that if you're not in it, you've got to buy stocks, and you need to do it now because they're going to pull this off. But the problem is, when we start looking at the actual data that the Fed sees, there's a reason they're panicking, because we are more likely to be in a financial meltdown than we are in the next bull market. And despite some volatility after the Fed's rate cut, the S&P 500's bullish trend remains intact, as the Fed's decision to deliver a 50 basis point rate cut was largely welcomed by investors. And this is true because investors want to always believe that the stock market goes up. They believe that if the Fed cuts rates, that lower rates are bullish for equities, despite the fact there's plenty of evidence that lower rates don't actually cause the stock market to go up. But there's reasons why you're going to hear lots of articles and lots of commentary about how the Fed has unleashed a wave of liquidity, and this is going to send equity markets higher. It's all designed to get investors who have sold or have cash on the sidelines to reposition into the markets, and what you see is a self-fulfilling prophecy that lower interest rates cause people to buy, which leads to higher stock prices. And again, the evidence is out there that 20 times the Fed cut rates, the stock market ended up higher by double digits. And so investors know this, and they want to get in it before it's too late. The problem is, this move is seen as a bold but necessary step to ease economic concerns without sending panic signals reminiscent of the 2008 financial crisis. And here's the problem, because if there wasn't a crisis brewing underneath here, the Fed would have only cut 25 basis points. There would be an argument, in fact, many experts made it, is there's no need to go 50, because once you establish a 50 basis point move, you start to establish that the next one's going to be 50 basis points. And that's a problem, because Powell made it very clear during his press conference this isn't the trend. But we know throughout history that when the Fed starts to cut rates, they usually make very large cuts, because the economy actually gets worse when they cut rates. But again, investors believe the soft landing narrative, and they're buying in a big way today. And we can take a look back at the NASDAQ 100 against federal funds rate. Let's go back to the last 3 times the Fed cut rates. We can see they cut big going into the dot-com bubble at a time when stocks were at all-time highs. And there's often an argument that the Fed cuts rates at all-time highs, but they always cut rates at all-time highs. That's how they do it. And this, again, creates this bullish atmosphere. But look what happened. The Fed started to cut rates. People came in and bought the dip and to send stocks higher. And then all of a sudden, the economic data reared its ugly head, and next thing we knew, we're in an all-out bear market. The same thing happened again during the global financial crisis, as investors came in and bought the dip, only to find out that they were going to get crushed by the market plunging once again. But as we look back to the latest time the Fed cut rates, everybody bought in and sent the markets higher until the pandemic hit, and then a flood of pandemic stimulus sends the markets even higher. Now we're at the case where people believe that the dot-com bubble and the global financial crisis were just actually the wrong thing at the wrong time. The Fed got it wrong. There was something else going wrong with the economy. This time it's different. The problem is it's not different. We're going to make that case because let's look further at what investors are hoping to see is that corporate profits are going to continue to rise on the back of a strong labor market, on a strong U.S. consumer, at a time when we're hearing from consumers the opposite is happening. Because as we look at corporate profits after tax against the federal funds rate, we don't see any sort of evidence going into the dot-com bubble that there was a problem. We do see corporate profits plunge during the financial crisis, something people believe is not going to happen this time. It started to happen heading into the pandemic, but this time everyone buys into the narrative. Again, lower rates mean the consumers are going to come out and spend in a major way. But the problem is that's not how it works, because we've talked about delinquency rates are rising, and even though we're going to see this transmit into credit card rates in the months to come, just because credit card rates drop a little bit doesn't actually mean consumers are going to be flush with cash and go out and spend. In fact, the evidence suggests quite the opposite, that when the Fed cuts rates, what you see is advanced retail sales, this adjusted for inflation, or what's called real retail sales, this shown in blue on a year-over-year rate of change, actually continues to decelerate. That has absolutely no impact on consumers, which is something we've noted that most people have no clue what a Fed rate cut does for their personal finances, because it literally does about nothing, and it doesn't change the trajectory of their spending or how they perceive the economy. But we can look, in fact, there's one evidence that we see over the last 3 rate cutting cycles that in 2019 we did see an acceleration of retail sales. But look at this time. We're in one of the longest periods where real retail sales is below the zero bound, and this is suggesting that retailers and wholesalers are in perilous situation right now, and they desperately need consumers to come out and spend. The problem is, what if they don't? Well, that's the reality, is they're not likely, because a little bit of a drop in interest rates isn't going to change the economy as much as investors believe. And we see bonds fall as a sign of strong jobs market following the Fed rate cut. Well, that was toward the intermediate long end of the curve. The short end of the curve didn't quite fall, and actually what we saw is rates go down, bond prices go up on the short end. But if you're trying to figure out where you should be putting your money right now, should be chasing the equity market higher, should be looking at bonds or something else, well, we've got the answers for you, because right now our CTA Timer Pro has 6 open trades, and we trade against the machines and we show you how to beat them. Right now, we have 4 trades are up. We had 2 stopped out, 1 yesterday, 1 today. We put on a new trade today, and look at this. We see this PPLT. This actually made a 3.73% return in 7 days, and you could get the edge here. Maybe you like to trade momentum, but you struggle with those RSI and the MACD, you trading it right. Well, right now, we have 2 open trades, added 2 today, and we've got a 100% win rate. But if you're wondering how easy it is to use, it's simple. 2 hours before market open, we publish the reports, and I give you my opinions. You just pick the trades you want, put a buy it open with a stop loss, and then go about your life. And then once a week, we tell you to update your stop loss, so you can do it as much as you like, and from there, you profit. It's that simple. You don't have to sit in front of your computer. You don't have to watch this all day long. You get the reports, you get the signals, you get my opinion, you get the backtest data from CTA, and yes, we're working on the Momentum Timer Pro to prove to you our reports are as good as we say. You get the stop loss levels, you get a full tracking of all the trades in return, a weekly update on your stop loss level, 100% ability to duplicate our trades, and the best part of the bomb, you get a 30-day free trial. Links in the description below. Start making money in the market, because we make it so easy. You could still have your life, still have your job, still have your family, and still make money in the markets. In early U.S. trading, yields across maturities climbed after weekly initial jobless claims unexpectedly fell. We'll talk more about that later. And stock index futures pointed to gains for the equity market that have continued to surge higher. Two-year yields more closely tied to Fed rate decisions and longer maturities, and briefly under 3.58% this morning in mounting anticipation of the half-point rate cut, rebounded to around 3.61. So here you can see at the short end of the curve, rates only went up a little bit, but after the Fed announced their decision yesterday, they actually fell. And here's what's key to understand is that lower rates do not lead to easier financial conditions. See, everyone believes that it unleashes liquidity, the financial conditions get looser, but what we actually know is that falling interest rates, and you can go back to Milton Friedman's research, he actually believed and did the research and said that lower interest rates lead to tighter financial conditions. So the fact that the short end of the curve is falling is actually dangerous, because what it means is things are going to get worse, and the Fed has got it wrong, because everybody believes, including the Fed, that we only needed this 50 basis point cut, and Powell walked back future cuts, but the bond market says, hey, you know what? Even if the two-year yield goes up to 3.61%, which is negligible from where you're seeing it here on this chart, what it's telling us is the Fed needs to cut rates, and it needs to cut them again, and then when they're done with that, they're going to have to cut them again, because we go back in history and we see two-year yields in blue falling, and you look at what happens. The Fed plays chase each and every time. And what the bond market is telling us, that the stock market is saying no, they don't agree with, is that financial conditions are tightening. And this is exactly what happened going into the dot-com bubble and the global financial crisis. You see that yields fell, the Fed followed, and a recession. Now, we didn't get that in 2019 to 2020 because the pandemic hit. Data would suggest that we would have likely seen it, but we'll talk about why that is. For the Fed, though, it's clear that it's all about the labor market as our main driver for monetary policy in the future, and this came up during the press conference. Fed Chair Powell was asked, hey, the labor market looks fairly good, so why are you cutting 50 basis points? It's because the Fed is worried here. There is panic behind closed doors. We're going to talk about that here in a little bit. And given that government bond yields have come down a lot in recent months, for us in fixed income, we see it as a very good environment for credit, being they believe that people are going to want to borrow more, but they're not. That's the problem, because financial conditions are tightening, and when financial conditions tighten, banks restrict the creation of credit even more. And that's a problem, because in a debt-based economy, you need credit to be created. You need the new money to get injected into the economy, but instead we're seeing a flood, a race into the U.S. equity market in hopes for the soft landing narrative, but history suggests it's highly unlikely that a financial meltdown is what the bond market's pricing in. And since we were talking about the labor market, let's take a look at what two-year Treasury yields are telling us about what's going to happen. And right now, when we look at today's data, which we'll get to here in a little bit, everybody starts to believe that maybe the Fed overreacted and the labor market is strong. But in reality, when you see financial conditions tighten, as evident by two-year yields coming down, you'll notice there isn't an instant reaction in the labor market. There is a bit of a lag, and the next thing you know, tighter financial conditions impact the labor market, and people lose their job, and there is no other option for them. You see that happen here going into the global financial crisis. The yields were falling, but there wasn't a large uptick in continued unemployment claims, and then they spiraled out of control. In fact, we look at around 2019 to 2020, we see yields come down and the labor market started to stabilize, but this time we see an increase in continued claims as financial conditions are tightening. Look for continued claims to hang out at their current level for a bit longer, and then all of a sudden the wheels of the economy likely to come off here and send us into a complete meltdown. Fed officials updated their quarterly economic forecast to raise their median projection for unemployment at the end of 2024 to 4.4% from 4% in June. Now we can look back, and Fed Chair Powell suggested that he thought the unemployment rate would just get a bit over 4%, but they keep revising the number higher and higher. And yet we see the reaction from the equity markets, that is, the stocks are going to boom here, the profits are going to rise. At the same time, the Fed's saying, wait a minute, we think more people are going to lose their job and get stuck there, and that's not good for the economy at all. Powell said last month that further cooling of the labor market would be unwelcome, yet they believe it's going to happen. The upsized cut to kick off the cycle is Powell's attempt at assuring the soft landing he's long had in his sights, and yet the Fed has never once achieved. And that is a dangerous game, because he is trying to convince everyone that the Fed can keep the economy running, but we know history suggests that the Fed has absolutely no power over the economy. And as we look at two-year treasury yields against the labor market, now we're going to focus on the unemployment rate. You can see that there's a reason that they're raising their expectations that the unemployment rate is going to rise, because they understand that falling yields lead to tighter financial conditions. And here you can see back again in 2000, 2007, and then a little bit here right around 2019, you see, of course, the unemployment rate start to bottom out. But look at this time, you see a rising unemployment rate against tighter financial conditions. You're seeing a very similar setup to what happened at the last two recessions, and is looking to repeat. And this is what the Fed's concerned about. They don't want to see us enter a recession because they know governments have blown out the deficits. They've racked up a massive amount of debt, and they don't have the ability to deficit spend through a recession like we would normally do, because we need an expansion. We need a chance to get caught up here, and it's not going to happen. And they realize that if they cut rates substantially and it doesn't make any difference in the economy, that it's game over. We're not just in a recession, we're in an all-out financial meltdown, and potentially something we haven't seen in many decades, which is a depression. And here we can see a portfolio manager at JP Morgan Asset Management. So the firm's not expecting a recession. Well, I had news for you, it's coming, but sees U.S. Treasuries as a good hedge against that unlikely outcome. Treasuries are good ballast, he says. For now, we do not expect yields to plunge. Well, I disagree with that completely, because when we look at two-year Treasury yields, again in blue, we're going to look at them now against the yield curve. And the yield curve is when you take 10-year yields and you subtract two-year yields. That's shown in red. And when you get to an inversion that's below the horizontal black line, well, bad things happen, because when you see an inversion, what it does is it leads to the constriction of creation of credit. And when that happens, particularly for prolonged periods of time, there just isn't enough money to sustain the economy. There isn't enough money to pay on all the debt. And that's why we start to see people enter delinquency and then default. And the next thing you know, everything starts to go wrong. And part of the problem here is we're in the longest inversion of the yield curve in history, and yet everybody says things are going to come out just fine. You had a small inversion that led to the dot-com bubble. You had a longer one, but a very minor inversion that led to global financial crisis. You had one that maybe lasted a day or two that headed into the pandemic. Now you have the longest one, and people are saying it doesn't matter. But two-year Treasury yields are saying no, financial conditions are tightening, and rates need to come down to spur the creation of credit, even though there is a huge lag. By the time yields come down, you don't see, of course, the banks willing to lend in this environment because they see the economy slowing. And as lenders, just no different than when you lend to a friend or family member, the first thing you worry about is getting your money back. The banks realize in an economy that's getting tighter and tighter, the odds of them getting their money back decrease, which is why they curtail their lending activities and send us right into a recession. But let's talk about what happened at the Fed yesterday during the press conference, as we now see the Fed opts for outsized cut as Powell seeks to ensure the soft landing, as if he has the ability to guide it. But he notes this is all about risk management, and the risk is that he got this completely wrong. And the fact that, well, he actually believes in what he does actually affects the economy. We know that's not true. That the Fed chief said launching the unwind of his historic tightening campaign with a big move while the economy is still strong would help limit the chances of a downturn, because the Fed doesn't want to take the heat on this. They need something else to happen. They need the economy, or the U.S. economy, or the global economy. They need something to break that they can point later and say, hey, you know what? We didn't see that, but we tried to mitigate the risk. The problem is the rate cuts will have no effect other than getting people to take on more risk in stocks at a time when history shows that could be a terrible move. But he was careful not to commit the Fed to a similar pace going forward, saying future moves will be based on how the economy performs in the months ahead, and based on what we're seeing, the economy is likely to get worse, which means the Fed is going to cut likely in November before the election and in December. We'll see what the data suggests between now and then. But the labor market is actually in solid condition. Well, I don't completely agree with that. And our intention with our policy move today is to keep it there. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. What's clear is they don't have an answer for why the labor market is getting worse. And if they actually believed in their own research or in their own narrative that actually lower cuts or lower funds rate, that is, would lead to a reduction in unemployment, then they wouldn't revise their projections higher. So I want you to see that their actions do not match what they put on paper and are telling us they believe the labor market's going to get worse. And if that's the case and the Fed cuts did something, why didn't they cut 75 or a full 100 or even more to say, hey, you know what, we need to support the labor market, because they realize it doesn't make a difference. And I don't think we're behind. He said, well, the bond market suggests you are. And you can take this as a sign of commitment to not get behind what, again, you already are. And I have the evidence of that, Mr. Powell, as the decision was not without some controversy, because Michelle Bowman cast a dissenting vote in favor of a smaller quarter-point cut, making it the first dissent by a Fed governor since 2005. And I don't think that anyone should look at this and say, oh, this is a new pace. Well, it actually is, and I'm going to prove it to you, as the economy can develop in a way that would cause us to go faster or slower. But the bond market is saying, look, it's saying just the opposite. Fed chair is saying, Powell, you need to cut. And he says turning points are hard. They're hard to judge. The data is complicated, and that's not what you want from somebody who is directing monetary policy from this country to say. You want them to tell you that the data isn't hard, that yes, it's complicated, but they understand it, and they know exactly what to do to get the desired outcome. But the reality is, when we take a look at 6-month Treasury yields as shown in red against the funds rate in blue, the Fed actually doesn't do anything but do what the market tells us and comes up with excuses for why they need to do it. And right now, the 6-month yields are actually going down, just like we've seen. It's telling the Fed that not only is your 50 basis point cut going to stick, you're going to be cutting more, because despite the fact that we see longer rates head a little higher today, short-term rates did not go up much. They actually fell following the announcement. They're going to continue to tighten. They're going to continue to lead the Fed lower. So 50 basis point cuts isn't just one off. It's going to be the norm. Fed Chair Powell knows this. He just doesn't want to admit it. Because U.S. jobless claims fall to the lowest since May and solid labor market. But I showed you that as financial conditions tighten, it takes a little bit of time to transmit to the economy. But so far, the data does look good. We see initial claims at 219,000, still historically low. We see continued claims dip 14,000 to 1.829 million, and on a non-season adjusted basis fell under 1.7 million, showing that people are getting back into the labor market. But look at this, total claims down 97,000. That is substantial. We're seeing big changes here, but will they stick? Well, as long as financial conditions tighten, it indicates they won't. And that's why you saw the Fed chair cut. Why they needed to, because they need to get the yield curve uninverted. They need to get the banks out lending. They need to get money into the economy before it's too late. The problem is, if you believe in the magic of the Fed, remember, increases in the federal funds rate come with long and variable lags. So too do Fed rate cuts, something the market's not pricing in, but the Fed realizes they're too late. They just don't want you to believe it, which is why, based on what the Fed just did, we're more likely to see an all-out financial meltdown than we are to see the next big bull market. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.